So you just refinanced because rates were extremely low, and now you have a low interest rate, a great payment, and you also have all this unused equity just sitting there. So how do you tap into that equity without refinancing again and doubling your payment, or without selling your property? Because that may not be something you want to do. Well, have you ever thought of a HELOC, a home equity line of credit? A HELOC is a form of revolving credit, which uses your property as collateral. Therefore, it's a mortgage. And since you're using your property as collateral, you're going to obtain a much better interest rate in comparison to a credit card. In essence, what you're doing is you're borrowing against your property's equity. Typically, we can finance up to 90% of the appraised value of your home. Let me give you an example. If your property is worth $1 million, therefore we can finance up to $900,000, less any current mortgages. If you have a current mortgage on your property of $500,000, therefore we can give you a line of credit of up to $400,000. HELOCs are second mortgages, which means that your first mortgage will stay intact. Nothing on your first mortgage will change. As for the HELOC second mortgage, you will receive a separate bill, likely from a different lender. HELOCs operate like a credit card in the sense that you can draw from the line up to the line amount, then you can pay it back and reuse it again. You'll be given designated checks or a designated credit card, which will allow you to draw from the line. And the funds, they're at your discretion. If you happen to borrow $50,000 for home renovations, you'll only be obligated to pay back on those $50,000, not the entire line amount. As a matter of fact, during the first 10 years, known as the draw period, you'll only be obligated to pay simple interest on the balance. You're always welcome to pay off the entire balance. However, during the draw period, you're not obligated to do so. Once the draw period ends, you'll enter the repayment period, where you'll be required to pay off any outstanding balance which you've accumulated, plus any interest, over a 20-year period. At this point, you'll no longer be allowed to draw from the line. As for the interest rate, HELOCs use a variable rate which is determined by a fixed margin plus the Wall Street Journal prime rate, which is a variable index. One of the beauties of using a HELOC is that it uses an inexpensive method to charge interest, known as the simple interest method, in comparison to a credit card, which uses compounding interest. Using the simple interest calculation, if you borrow $100,000 at 7.5%, then your obligated interest payment is $625. Whereas compounding interest is where interest is charged on the balance plus previously accrued interest. So it's interest on interest. Some credit cards compound interest on a monthly basis, and some credit cards compound interest on a daily basis. I'm sure you've noticed that it takes forever to pay off your credit cards. That's because the compounded interest is being added to your outstanding balance. Let me recap on the benefits of a home equity line of credit. Number one, you can tap into your home's equity without disturbing your current first mortgage. Number two, it's a revolving line, therefore it's available for continuous use during the draw period. Number three, you only pay on what you use. So if you don't have a balance, you won't have a bill. Number four, because HELOCs use your home as security, they will offer a lower interest rate than credit cards. And the interest calculation that's used is much less expensive. Number five, because HELOCs are mortgages, they are tax deductible. Come tax time, you can write all that mortgage interest off. And some typical uses of a HELOC are to consolidate high interest rate loans. You can use it to fund an ADU or the expansion of a home. You can use it to renovate your home. Maybe you need some roof repair or a new bathroom, brand new kitchen. You can buy another property. You can use it for a down payment or pay the property off in full. Lastly, I'll leave you with this. In business school, we were taught an important lesson that you want to apply for credit, loans, lines of credit when you're in a healthy financial situation. Basically, when you don't need the money. Because heaven forbid, if you happen to enter a financial crisis where you actually do need some money, you may find that no lender will be willing to lend it to you. And a line of credit is a form of insurance so that you don't have to refinance into a high interest rate loan, or worse off, sell your house when you don't want to. Hopefully I was able to clarify on how a home equity line of credit works. And if you guys do have more questions about maybe interest rates, how to qualify for a home equity line of credit, how much money you can tap into, please give me a call. My name is Josué López and I am the broker at Grow Mortgages. Hope to speak to you guys soon.